Welcome to BWC News. I am Elizabeth. May 4th, just as the U.S. banking storm is still festering, further damaging U.S. financial prestige, overlaid with the Federal Reserve raising interest rates by 25 basis points as expected and hinting that further rate hikes may be suspended, giving policymakers time to assess the consequences of the recent multiple bank failures. Bloomberg News on May 3rd, Federal Reserve Chairman Jerome Powell said that if the government debt ceiling is not raised, that would be unprecedented and would bring a high degree of uncertainty and negative impact on the economy. Powell said at a press conference Wednesday local time, "We would be in a position we've never been in before, and its impact on the U.S. economy could be adverse, and there's so much uncertainty that no one would think the Fed could protect the economy from the potential short and long-term effects of a debt default." The Fed announced a 25 basis point rate hike on Wednesday. Powell said officials discussed debt ceiling risks, but did not influence the rate decision. U.S. Treasury Secretary Janet Yellen sent a letter to congressional leaders on Monday local time and warned that the U.S. federal government could hit the debt ceiling and default on its debt as soon as June 1st. Yellen noted, after reviewing recent federal tax revenues, the U.S. Treasury estimates that if Congress does not raise or suspend the debt limit by early June, we will not be able to continue to meet all of the government's obligations, and it could happen as early as June 1st. Just a few days ago, Biden publicly stated that he would veto a resolution passed by the U.S. House of Representatives to raise the U.S. debt ceiling with conditions. China has responded clearly with real action to the falling U.S. debt. Both U.S. debt and the dollar are in a cloud of gloom and doom, giving some international capital a good opportunity to short. A number of people are shorting the dollar today, including Druckenmiller. Druckenmiller is a very legendary figure. Druckenmiller has twice won in the foreign exchange market. One occurred in the second half of 1989, when it was thought that the merger of the two Germanys would hit the German economy hard. Druckenmiller chose the opposite direction. He was optimistic about the German mark. He invested $2 billion, bought the German mark and subsequently made a fortune. Druckenmiller made another correct prediction in 1992 that the pound would fall against the German mark. Then Soros led the financial capital that defeated the Bank of England. In just 1 month's time, he made another billion or so. This time, Druckenmiller said that the Federal Reserve Board, which has been running wild in raising interest rates for some time, will soon be forced to lower them again. And this will be a huge blow to the value of the dollar. He also criticized the current Fed Chairman Powell. "I don't think he's a very brave man. By 2040, he said, spending on seniors will reach 100% of federal tax revenues, including interest payments, according to Congressional Budget Office (CBO) estimates. More importantly, the current $31 trillion U.S. debt burden does not include future benefit payments. He estimates that when this burden is taken into account and calculated in present value terms, the actual U.S. debt burden could be closer to $200 trillion. In addition, he also does not believe in the Biden administration's ability to govern, saying that the economic situation in the United States under Biden's rule is not optimistic. Now the U.S. debt is facing a ceiling crisis has been nearly half a year, but so far, there is no substantive response plan. Indeed, whether the Federal Reserve or the White House, in response to the U.S. debt crisis, the ability to perform very poorly. It is not that there has been no action on the part of the United States, but only to do some useless work. For example, U.S. Treasury Secretary Yellen has repeatedly raised her desire to visit China, and her purpose is self-evident. She just wants China to stop selling U.S. debt and increase its holdings in the opposite direction. But the reality is that we have not responded to this, but instead continue to sell U.S. debt in our actions. When the Fed raised interest rates, we in China stepped up to the plate, relying on selling U.S. debt, minimizing the appreciation of the dollar, and resisting the Fed's harvest for many small countries. Of course we do this, but also for the future returns, these countries in the repayment of money with the yuan to pay back on the line, so that is a double whammy, depressing the dollar exchange rate at the same time, to improve the status of the yuan. Moreover, the current situation in the United States is not something we can save back. The U.S. debt now has a big hole, even if we join forces with other countries may not be able to fill the gap. The IMF released data on the composition of official reserve currencies, showing that in the fourth quarter of last year, the US dollar accounted for 58.36% of world reserves, while the euro came in second at 20.5%. Compared to the past, when more than 70% of the world's foreign exchange reserves were in dollars, countries have now started to abandon the dollar. Since the US is now in trouble, we naturally go with the flow, selling US bonds first to avoid losses, keeping cash on hand to wait for opportunities to incorporate quality assets flowing from the US into our arms in the future.